1 year ago, I came out with this episode, how I'll invest 100,000 for dividends. And I came up with 4 names. Not just that, I broke down how I'll invest 40%, 30%, 20% and 10% respectively. And these were the 4 companies. You see that Bowsteed and Centuron having 40 and 30% has jumped massively, correct? Sets had 20% and Raffles Medical had 10%. So all in all, performance was fantastic. In fact, if you compare that against, for example, OCBC, you realize that this portfolio has massively outperformed. And by how much? I did a fun back calculation and that portfolio actually grew by 76%. Major contributor, of course, was Centuron. So my challenge now actually is to replicate this for the upcoming year, correct? But actually, let's not set expectations so high. If we can outperform market, I think that's fun. But the whole idea of this discussion is to give you some good investment ideas. Hi guys, welcome back. Without further ado, let me share with you what I have for today. And I'll change the parameters slightly. Right now in July 2025, markets are super bullish. I shared on our Telegram channel that as of now, there are a lot of mean reverting property related counters. There are a lot of small cap industrial players that are going parabolic in share price. How long will this last? Nobody knows for sure. But I want to choose these 4 names because I have 2 key ideas. The first is that right now, when markets are so rosy, I want to project 1 year later, will things be very different? Will there be recession noise or not? Now we talk about recession, nobody believes really. But people are very fickle. By start of next year, there could be all sorts of recession fears. So I want to position this portfolio very defensively. The second, I want to highlight names that could benefit from MAS's 5 billion stock investment program to invest in the Singapore markets. And as you can see from the headline, global investor program applicants are also required to invest more into local equities. So this is actually why the local stock market has been revitalizing. This program is not going to invest in the blue chips. So as you can guess, for today's list, there's not going to be any banks, there's not going to be any REITs. It's all small and mid-cap companies. Don't discount them also. These are companies who have been around for many years. They are definitely not penny stocks, not speculative. But before we get started again, this is not financial advice also. I'm suggesting names, hopefully to inspire you to research further for yourself. So without further ado, let me start with the first company that I allocate 10%. This company is on a comeback trail. Its directors have been buying for quite a long while as I've taken notice. It has exposure into the semicon sector. This company is none other than Franken Group. Franken is in the industrial business. Some of their industrial products we have never heard of. That is one reason why I'm only placing 10% allocation with respect to my lack of knowledge of the industry personally. But if you were to see from the books, we can quickly understand what Franken derives its revenue from. Circled in yellow is Analytical Life Sciences segment. That is just a very stable cash cow, nothing special, but the one that's circled in green is the spicy one. Semicon is 46% of revenue and growing. If Franken were to do well, this needs to do well. And what we can see from latest first quarter updates is that this segment, semiconductor, has jumped 33.7% year on year. This means that sooner or later it will be more than half of what Franken derives as revenue. I don't even know, but Franken's key customer is actually someone who's a very important tech player. This company is ASML. They have a near monopoly of the lithography system needed by semiconductors. Which means also, if ASML gets orders from semiconductors, Franken stands to benefit as a subcon. If we were to plot the share price of Franken and ASML in this chart over here, the green one being ASML and the pink one being Franken, you would realize that for many years, they seem to be trending upwards together, correct? Then in 2022, there was a slowdown in semiconductors. Both had correction. But what happened? With the AI boom, ASML started to climb back in share price, but Franken was left in the lurch. With this chart, I can conclude 2 things. The first is on a long-term basis, ASML's fate and Franken's fate seem to be closely correlated. And if that were to be true, it is arguable that Franken, at share price today of $1.40, is possibly undervalued. It is right now half of its all-time high, whereas ASML is closer to its peak. The second conclusion I have is that ASML is likely the better long-term compounder. They have a much better economic moat. Franken as a subcon may have other competitors to fend off. Therefore, margins are less protected. However, in an upcycle where everybody has a lot to eat, there is a chance that Franken may outperform as a small cap company. In addition, there's this 5 billion MAS investment, correct? And with some flows there, outperformance might come. Let me know in the comment sections whether you agree or not. And let's move on to the second company for today, which might also surprise you. This is someone I haven't covered before, and it sounds like a very boring name. This company is none other than TO MOOMOO. If it rings a bell, it means you have seen their cranes before. And before you think cranes are very boring and unprofitable business, let me share with you what I understand and why at this moment I have a small stake in it. In this portfolio, I'll be allocating 20%, even though TO MOOMOO's share price has shot up to 74 cents as you can see currently. Price earnings ratio for it is 8.74 times. And to decide whether it's still cheap, we need to understand what are the key drivers why markets favoring construction industry stocks. The first is this recent news that MBS is going to upgrade and build one more massive tower. This is meant to be a luxury tower and it's going to cost $8 billion. For any mega project, TO MOOMOO's cranes have a very decent shot of being employed. The next mega project is actually this, Changi Terminal 5. And this is even bigger project in absolute size. The ticket value, $10 billion. And this project has already started issuing contracts out to main contractors. In my layman interpretation, some will naturally flow to TO MOOMOO. That's because TO MOOMOO is specialized in these kinds of cranes. They are called the heavy lift and haulage segment. You would see them building BTOs, you would see them building commercial buildings. You also see them in industrial projects like the two I've mentioned. And just to confirm things, UBK has actually a report to suggest that they are one of the key beneficiaries as highlighted over here. TO MOOMOO is a heavy lift logistics operator and it will benefit from demand from large-scale construction like Terminal 5 and Tuas. Forgot to mention, Tuas Terminal is a 20 billion multi-year project. So Singapore is building a lot of stuff, of which some have to flow to TO MOOMOO. TO MOOMOO is indeed very competitive. I don't even know, they are one of the biggest crane operators in the world. And their business operations is not just in Singapore. Over the last 7 years, you will see that they have been growing their profits as well as dividends. And before I get too excited that TO MOOMOO should be a buy and hold indefinite company, I'd like to re-highlight again. 7 years track records of profits and dividend growth is because 2016-2017 were bad. They were down cycle years which could cause losses simply because of lower projects and high fixed costs and high material costs. That is my interpretation of TO MOOMOO. Personally, I think it's still a very favorable time to be invested, and that's why I'm allocating 20%. The third company I have for today is someone that I know way better individually than TO MOOMOO or Franken. That's because I work in the financial space, correct? This company I'll allocate 30% is none other than iFAST. If we see a share price chart, iFAST right now is at $6.91. And even though it's grown massively in the last 5 years, it seems to be sitting quite far off its all-time peak, correct? And the reason share price is low now is because the Hong Kong segment has been slowing down. iFAST has won a major e-pension contract, and that was a game changer for it. That's also why, in my eyes, it deserves its price earnings ratio of 29 times. Because, as you can see over here, it's growing its profits by 30+% year on year. So on a price earnings growth ratio, I believe iFAST is still potentially cheap. The cons of iFAST, of course, is that if equity markets do slow down, just like I mentioned that there could be recession talk again next year, correct? If markets do slow down, any brokerage business will slow down, including iFAST. We also need to observe closer on the e-pension growth. Is it weaker than projected, or could it rebound back to a high growth phase? Results will be coming out for iFAST very soon, so if you're keen for a full tutorial, smash on subscribe. I'll share them with you once it's released. iFAST, in my opinion, should be on every Singapore growth investors watch list, and it ranks very high for many analysts in terms of how they will view where MAS's $5 billion will be allocated. There are already not that many fintech firms for people to invest in, and iFAST clearly is one of them. Just now we ran through 10% into Franken. Franken is benefiting from the semicon upswing. 20% into TO MOOMOO. TO MOOMOO is benefiting from the construction upswing. 30% in iFAST. iFAST is benefiting from this Hong Kong e-pension and right now could be undervalued. So where are we going to allocate 40%? I thought long and hard and I've decided to choose something a lot more defensive. Even though this company is defensive, currently share price is still at an all-time high. You're definitely familiar with it if you stay in Singapore, and this is none other than Sheng Siong. Sheng Siong at $2.07 seems too expensive to some, but hear me out on it. Price earnings ratio at 22 times is still below industry average. And there's actually growth that Sheng Siong is experiencing. DBS has actually raised its target price for Sheng Siong from $2 to $2.30. This is on the back of strong earnings growth and resilient margins. This margin part is very interesting because for Giant and Cold Storage, when they sold out to an investor, the valuation wasn't very good per store. But Sheng Siong actually has a very strong margin that is even better than NTUC fair price. So whatever you think about its brand, the numbers speak for itself. Maybe all the aunties, uncles love to shop in Sheng Siong, and operationally they've done fantastic. Because operations is all that matter. How you source and how you distribute affects your margin, and Sheng Siong has proven over the years that it's operationally very excellent. This is in Singapore only, unfortunately. Sheng Siong is trying to build its brand in China, and for a few years, with 6 stores, it's still loss-making. So the only con in my eyes for Sheng Siong is that it's kind of stuck in Singapore. Even though they've managed to win multiple new locations, the growth path is kind of more gradual. But again, if there's a recession, no worries. This is a very, very defensive company. And that's why I'm allocating 40% to anchor the entire portfolio. All in all, on the share price chart, this is how it looks like. I have 2 all-time high companies. I have 2 companies who could be undervalued. I put Sheng Siong and iFAST on the top because personally, I'm very familiar with them. And I value them substantially higher. On the other hand, Tiong Woon and Franken could outperform if what I've suggested on the growth story turns out to be true. Let me know what are your thoughts on this 100,000 portfolio. Leave them in the comment sections and I'll see you in 1 year's time. And let's keep track on its performance. Thank you for watching right at the very end. Let me invite you to this previous video I had on 7 stocks that you should look at that are possibly better than banks. Check it out and it ties in today's video also. If you don't sign up from here and see you there, take care as always. Goodbye.